Hey everybody, welcome back to our weekly podcast. My name is Patrick Tan, General Counsel for ChainArgos, and with me as usual every week our CEO and Chief Data Scientist, Jonathan Reiter. Thank you for tuning in. Thanks for joining us from wherever you are. We've got three topics to speak to you as usual. We're going to be talking a little bit about the Gemini Settlement with the CFTC. John will give us all the dish on that. A proposal to somehow peg USDE to USDT's price on AAVE. We'll talk a little bit more about that as well.
On AAVE or in AAVE? I don't know what the right...
Around AAVE.
Yeah, something like that, yeah.
And then the OCP emails. This is basically some FOIA requests that took out a whole bunch of FDIC letters that were written to a whole bunch of banks regarding their crypto asset activity, mainly covering the 2022 period. And we'll have a look at those letters and see if some of the allegations are true. But let's just jump straight into the Gemini settlement. John, please.
All right, so Gemini was originally charged by the CFTC. This is 2022, I think.
Yeah.
So this is just over 2 years ago now, later 2022. And the allegations are pretty ridiculous. So I think we have to do a little history before we see what they just... So we'll go through what those allegations are, and then they've... without admitting and denying whatever wrongdoing, they've consented to the entry of an order. They're paying a $5 million fine. It's important to note that what they did is pretty ridiculous, but the volumes were pretty small, and the important fixing that they ended up lousing up, whatever, doesn't exist anywhere because no one used the product. So I don't know that a huge fine would ever have been justified given the economic substance of what happened was tiny, as we'll see in a second. But I find it most interesting that such egregious things were settled a few weeks before the Trump stuff starts, and clearly these are not people who thought they were going to get off if they waited. I don't know what that says. We'll talk about that in a second. So CFTC went after Gemini for an interesting collection of crazy behaviors. So years ago, the CBOE, so one of the large U.S. futures exchanges, had a Bitcoin futures product, and the fixing price, the settlement price, was set by an auction that was run every day at the same time in the New York afternoon on Gemini. All right, so that auction was the sole pricing source for a listed futures fixing, and they knew that was all part of the arrangement. So in that sense, the regulator has a clear interest in making sure that the processes around that fixing and everything related to it are very reasonable and transparent, because a major U.S. futures exchange is using it as the pricing source for settling up payments every day. So that's kind of the highest degree of scrutiny the CFTC would ever apply to anything, futures delivery specifications and whatnot, because this is directly what's pricing it. Now, it turns out that, they had some weird internal staffing problems, but okay. So the first issue is that people had brought within Gemini complaints about self-crossing, trading with yourself, internal wash trading, those sorts of things. And discussion with, in the original docs, was called Gemini Principle 1. There's another place where they talk about Gemini Principle 1 and Gemini Principle 2. These are obviously the Winklevoss twins. Wrote with regarding people trading with themselves in this auction, again, that is providing pricing source for a futures exchange. It's really up to the market makers. Market makers are grown-ups. They can figure it out. So the attitude is just, go deal with this yourselves. This is not our problem, right? The exchange is not supervising people trading with themselves in the price discovery process with respect to fixings. That is not ideal. Now, people may or may not defraud you, set up accounts you don't know we're the same person, right? FTX, we talked about people. It turns out they're all the same account coordinated. This is one where they clearly know that they're the same people, and they're saying they can deal with it themselves. In fact, the connections are a little bit deeper than that. So it also turns out, I'm just going to read quotes from the earlier documents here. A potential auction participant expressed concerns to Gemini personnel about having cash or bitcoins in their account in order to participate in the auction, and asked for a line of credit. In response, Gemini personnel indicated, among other things, I can ask Gemini Principle 1 or Gemini Principle 2 if they do a personal loan to you guys. So there's a number of problems here. One of the things that they're consenting to, whatever, they're admitting, is that while they claim to be a full reserve exchange, customers were trading on credit. Right? And even more absurdly, the credit was extended by management of the exchange in a personal capacity. So you can't go to a stock exchange, broker, any of those things, and ask the CEO if they'll personally loan you something and just credit your account on the exchange so that you can trade in the auction process that feeds a futures fixing. That's nuts. this is probably a good time to mention that if you went to the site at the time to participate in this thing, Gemini slogan, branding on the site where you entered these orders, it said, quote, "Trust is our product," in large letters, which I just think is ridiculous if people are trading money they've borrowed in a personal capacity from management. Right? So, okay. In a later discussion regarding certain Gemini market maker customers, one of the Gemini principals said, quote, "A number of them are using my capital, which makes up a material amount of their balance sheet." Okay, so again, people trading on credit and credit extended by management in a personal capacity. This is what they're getting in trouble for. Now, we reemphasize what we said at the beginning. The volumes through this Bitcoin auction were never huge. The real volumes may have been effectively zero if it was people trading with themselves. This is not a way to determine prices for settling a futures thing. Now, whether the futures, the CBOE futures never took off because the pricing source wasn't used and the whole thing was just useless, or whether there just wasn't demand, whether it was too early, whatever, it's kind of hard to say. It is clear, however, that once these futures existed, people were not actively trying to trade the cash versus the futures to the ARB. That would be an active thing if the product took off. Right? The product doesn't exist only for one market maker to borrow money from management and trade it against themselves, against a futures position they probably have with themselves as well. Right? That's not the way that these things sort of normally go. So, okay. I mean, there were also interesting allegations in that Gemini had some people who were speaking to the regulator who they then fired for being dishonest and then effectively lied to, didn't disclose clearly, whatever, to the regulator why that person was no longer in the meetings, which I would imagine pissed everybody off. So I'm not really sure. I mean, these were really kind of the worst possible conduct. So an exchange that claimed to be no credit extending and trust is our product. It turned out that they were extending people credit personally from management, allowing them to trade on credit and allowing them to trade with themselves into the auction process that generated a daily fixing that they knew fed a major futures exchange. I don't know how you can be worse. I mean, in some sense, this is just as bad as FTX fraud going bankrupt. It's orthogonal. It's a different set of problems, right? But in terms of insolvency, this is clearly nowhere. But in terms of market integrity,
well, not really a market.
Yeah, I mean, this is just crazy, right? FTX had a lot of issues. Like being insolvent is terrible, but it's nothing to do with whether or not the trades are actually happening. Here you have people trading with themselves and lying about whether the balances have been funded. I mean, that's almost exactly the same problem as Alameda, where they were extending credit. The Winklevoss made good on the things, whatever, but the misrepresentation is the same. I mean, there is a difference between misrepresenting solvency and turning out to be solvent, and misrepresenting solvency and turning to be insolvent, right?
Yeah.
But this will let people trade with themselves, and well, it's not even a problem.
And borrowing from the people who are organizing the forum.
Yeah, that's just not. That's just not on. The CBOE probably didn't know about this at the time. That stuff stopped years before this even came out. But they would not have been pleased.
But you can imagine that in some ways it was a blessing that it never really took off, because if it did take off, then you can imagine the rampant manipulation. My
guess is that they wanted it to look like a big fixing so that people would participate and they could slowly withdraw the self-trading, and then it would turn out to just be a legitimate large trading process and it's all fine. I mean, we still don't really know exactly what happened with Gemini, because it's been around for a very long time, but it never really got to be very large or went anywhere, and we now know, we've known for a while, whatever, a reasonable fraction of the activity was, fake. This is fake, right? Borrowing money from management to trade with yourself is economically meaningless.
Yes.
Because if you're buying and selling to yourself, you're not doing anything, and if it's not even your money, anyway. So whether they were trying to fake it for all these years, hoping people would show up and play in the playground, and nobody ever showed up. I don't know.
I mean, to make it a little bit easier to understand, would this be the equivalent of like a casino hiring a bunch of people to come to the casino to play, but the casino gave them the chips themselves?
Yeah.
Right?
If you wanted the blackjack room to look busy, and you just told people simple rules, gave them a bunch of cash, and had them go do
have them come and then help them play. Yeah. So all the volume that you run through the casino is completely horseshit, because it's your chips anyway. It's your money.
I mean, you could easily give people money for roulette, because there's no, whether or not there's skill, they could maybe imitate it, but like roulette, the casino we're going to pay you $10 an hour and give you $100 an hour worth of chips. Just go, whatever the amount, doesn't matter. Just go spend it, right? And your chips can't be cashed in, so there's no way for you to arb the system and roulette, whatever. Yeah.
You could win, but at the end of the day, so what if you win?
It's all random. It's the casino's money.
Yeah, you just have to keep playing.
Yeah. So it's it may turn out that Gemini had proper KYC compliance procedures before everybody else, and so they didn't get any customers.
Fair enough.
But they could never sustain a proper market, and by the time they got this stuff together, it was way too late. I don't know.
Possible. Okay, switching gears, let's move on to AAVE USDe USDT. So USDe is an interesting product. Maybe just give us a quick TLDR what USDe is. We've spoken about this before, but if you missed those earlier episodes, just in one paragraph, it's something by Athena.
Yes, it's an algorithmic stablecoin, generates yield, but they're very clear. It's got a whole bunch of different sources of yield, various funding basis, whatever. It's a stablecoin backed by a long crypto position and a short perp position in the same crypto asset. So that's supposed to have a net stable price. You have to pay margin, whatever. It pays yield from that and other basis trading activities. And even the designers, whatever, when it first came out, were very clear. We are not claiming this thing is definitely worth $1 at all times. There are failure modes. These are some of the failure modes, whatever. And I think at the time we said specifically, I think people are underestimating how many failure modes there are. But it's nice that the people behind the project are being honest that there are failure modes that are well understood. For example, persistent negative funding on many of the assets they use. Also, they use generally centralized platforms for the futures trading, less than they did at the beginning. And if those platforms disappear, clearly the system will collapse. Right. So it seemed like this was a case where, if they've got 20 different yield sources, these are approximate numbers, right? But say there's 20 of them, and then so 5 cents of each of the dollar is in each whatever source of whatever something, and so dropping to 95 would be, maybe not that impossible because that means one of the things fails, right? Negative funding for a while goes to 99 cents, whatever. Also, the mechanism has sort of throttling for the amounts that you can mint and redeem under certain circumstances. So if somebody was liquidated and had an urgent need for $100 million, whatever, worth of redemptions out of the stablecoin, they might find that they can't do that for a little while, and so they might decide to sell at 99 cents somewhere else. Right. So you could see the price dipping short term, definitely for meaningful periods of time, and there are also scenarios in which it would dip for longer periods of time. The discussion here is about a proposal that probably won't pass now, given the amount of shouting, to hard code USDe to be worth 1 USDT within AAVE. Right. So the basic argument in favor of this is that it's simpler, it would make certain things easier to use, and that it would just maybe drive more people to use AAVE. AAVE is huge, but maybe more people would use AAVE. That's the short pro argument. The short con argument is, you're ignoring price as a signal in a risk system. Good luck with that. And you're effectively saying that AAVE is now just going to absorb or socialize in the AAVE ecosystem problems with USDe, right? Which is not what AAVE is supposed to do, right? It cuts in a couple different directions, but if you read some of the commentary regarding this, it's a quote with the, while the setup adopted by Athena for USDe makes this volatility being dips, below $1, the peg. If it were to happen, it would present liquidation risks for AAVE users in the protocol itself. Right. So USDe is designed okay, it's probably fine. But if you have a system where AAVE doesn't understand these assets are different, people would have to find ways to liquidate where there were USDe problem in other ways. Because AAVE wouldn't say, oh, your collateral's dropped from $1 to 96 cents, whatever, trigger the liquidation process. People would simply start liquidating the staking receipt tokens they had or the governance tokens, or whatever, where they thought the loss was going to go. You'd probably also see, people remember famously with the Luna explosion and other stablecoin problems, curve pools started getting super imbalanced as everybody shoves in the garbage tokens to take out the good ones. You'd see AAVE ending up filled with the bad tokens at the wrong price, and then people liquidating by selling the A tokens somewhere else because AAVE didn't run a liquidation process. Right. So if you had a receipt for a pool that now consisted of a bunch of stable coins that weren't worth what AAVE thought they were, the AAVE mechanisms won't give you the right price back, so you'll secondary market them. You probably would see people producing Uniswap pools or whatever for things that they wouldn't normally have traded much in that sense, and start dumping them out. It would be chaotic, certainly, which is interesting.
Proposer is Chaos Labs, so there you go.
We were just talking about this. One of the risk. Yes, so some risk consultants put this together. I find it particularly amusing that risk consultants proposed suppressing the information from a risk signal. Right? If the price of USDe goes to 99.5, it might be a trading opportunity. Whatever. I don't know. It might be a sign of impending doom. It doesn't matter. But it's a signal. It's data. It means something. It means it's trading at 99.5, not at $1, and you should take advantage of that. I mean, react to it, use it, be aware of it, do something, buy it, sell it, whatever. I mean, the analogy we were using earlier, this is Cliff Asness refers to as volatility laundering, right? So there is a certain amount of risk. You think of a chessboard, whatever, all the squares, 8 by 8, right? So there's 64 units of risk, say, on this chessboard. And you can have 1 unit of risk in each square, which says this thing might go to 99.5. There might be some liquidations, might be a little bit of trouble, but you'll deal with it. It's minor, but it's fairly likely to happen. Or you can do what they've done here, which is shove all 64 units of risk in one corner. And if you ever get there, it's catastrophic. But as long as you're not there, it's no problem, right? This is, almost literal willful blindness. Now the system could decide we would like AAVE, because this is a good business proposition, to take this risk in exchange for a fee or not a fee. It's not clearly getting any money here, but would at least be getting perhaps more business, right? Loss leader, electronics stores, shops putting stuff in front, huge discount, maybe sell at a loss, get people in the shop.
Razor blades.
Yeah. That kind of thing. That may well be fine. It's not even wrong to decide business-wise we think it's worth this. And I don't even know that I think it's a stupid proposal in the abstract in that sense. But I do think that it's weird that risk people would think that it's okay. Right. So there's one thing to say it's a business decision.
The guys who designed the Death Star, they decided that they're going to have that thermal exhaust port be the only weakness. They put all the risk in that one.
Didn't we learn subsequently that was intentional? It was an inside job?
That
was the point of one of the later
that was
movies.
the point, but,
I don't think this is one of the later movies. But, it's one thing to say this is risking the viability of the entire platform, but we think it's worth it because A, the fee is worth it, or B, the increase in utility, simplification, user experience is worth it. It's a business judgment. That may reasonable people can disagree about that, but just saying, it's simpler because if it dips, it's just going to dip short term and come back for sure. So let's just not have those extra liquidations. That doesn't. That just doesn't. To me, that just seems crazy. That seems like you shouldn't use these risk consultants anymore. Again, there are ways in which you could present this proposal that I personally think are not a good idea, but could be okay, right? We're going to accept these 7 different stable coins. We're going to continue them all to be $1 because it's much easier for users that way.
Correct.
FTX, again, I think we're harping on FTX doing stuff well, maybe for a weird callback here in this podcast, but their stablecoin basket of the stablecoins you could redeem for dollars in U.S. banks easily, they considered interchangeable because, frankly, they were interchangeable.
Yeah.
Right? USDP, GUSD, whatever. All these were Paxos-y things or similar, whatever, BUSD, you could just redeem for cash, and users actually didn't care, and it did help simplify that part of the experience. That was better. So they could make that decision here. Now these are algo, not fiat-backed, whatever. I'm not saying it's identical, but that kind of business decision. But it's not being approached that way. It's being approached in a lot of the crypto sort of fake quanto babble, maybe quanto babble, right? Fake there's fake risk arguments that make no sense. Are just transparently wrong when there are possible legitimate business case to be made. Again, I wouldn't vote for that, but it's not.
We'll
it's
see.
Not crazy.
I don't think this thing will pass anyway. No. Yeah, I don't. But it's as you mentioned to me, I think what it does do is it gives us a sort of a glimpse, a window into the thinking of the people who operate in this environment. Yeah. The same way how I've often struggled with the idea that you could keep rehypothecating that $1 over and over again. You can't stake something and get liquidity from the thing that you staked.
Well, you can. It's just, again, not a very good idea. Relying on that to not be a house of cards that collapses is the problem.
It's,
Although then there's allegations here that the people who proposed this are also paid by the Athena folks, and so they have an interest in getting more cash.
Yeah, maybe.
That,
who knows? Right. Who knows? But I think it's weird also because the Athena folks themselves said that this isn't supposed to be a stable coin. It's not supposed to maintain.
And that short-term dips.
Yeah.
No, if you put in a throttling mechanism on redemptions in any capacity, short-term dips are going to happen.
Yeah.
That's the design decision you've made.
Anyway. So finally, and I like this one, the OCP 2.0 emails. Basically, long story short, this is the whole, a whole bunch of FDIC letters have been released under a Freedom of Information Act request, and Yeah, please take it
Well,
away.
okay, so there's a bunch of allegations that this is about the FDIC trying to shut down crypto banking and the rest of it. I guess we should say at the beginning that there were issues with them forgetting to the original responses to the Freedom of Information Act requests were missing files and the rest of it. And yeah, that's obviously mistakes are bad, and if you read through it, it certainly looks like the government's time scale for replying to people sometimes maybe isn't the quickest possible thing. I mean, you'll see
Fair.
the letter is dated whatever, and they received a notification weeks earlier and didn't even respond with a list of questions. So nobody's defending that everything the government does is perfect, and that's not what's happening here. But some of the and there clearly are things that were not done ideally, right? It's a system run by people, whatever. Some of the bank conduct that you get from these letters is just wild. So I'm going to read here. This is, I think, the most ridiculous, and then we'll go through some other excerpts. So this is a response from the FDIC to a bank regarding services, Bitcoin trading, whatever stuff they were going to add to the website. This is from mid-2022. So it's, during the meeting, the General Counsel informed the FDIC that the program is live and that the bank does not directly engage in Bitcoin activity on behalf of customers. The activities are transacted on a platform provided by redacted that's integrated into the bank's online banking website by a technology service provider. And the General Counsel committed to provide additional information. So in this case, the FDIC, Deposit Insurance is what those middle two letters stand for, right, is saying to a bank whose deposits it insures, apparently you already have a live Bitcoin trading facility integrated into your website, and your General Counsel is promising to provide us with more information soon. So the FDIC pays out deposits, subject to insurance caps, the rest of it, if banks blow up, banks go under, whatever. They're the ones on the hook. They're the insurance provider. And the insurance provider is entitled to understand what promises the bank is making to customers. Right? A lot of the rules around the FDIC concern what promises you're allowed to make and the forms in which you can refer to FDIC, whatever. Insurance coverage, and this is mid-2022. This is a time when a lot of people were discovering crypto services had been misrepresenting their FDIC coverage status, right? Voyager, various issues with omnibus accounts, Synapse explosion is still revealing these types of problems. There's still underlying problems like this in the banking system. So you have to think of this not from the pro-whatever Bitcoin or any whatever perspective. This letter is written from the FDIC. The FDIC's perspective, this bank has a live program that allows customers to trade Bitcoin on their website. They didn't tell the FDIC the details of the program. They're committing to provide the information soon. And you think of this as the insurance provider, you're thinking, well, there's a website out there facing retail that says insured by the Federal Deposit Insurance Corporation down at the bottom, and it has a Bitcoin balance next to a dollar balance. That's not cool. That would be confusing. That is confusing. Voyager, wonderful example, was confusing in this this fashion to many people. So I don't know that by itself is choke point anything, right? The bank was trying to get one over on the FDIC. We're not ascribing, we didn't see the communication of the direction. That wasn't released, whatever, fine. Just saying on its face, that's not absurd, right? There are a number of other, just pick another letter here randomly from this set of things. So here we've got that's a smaller one. Sorry. So the FDIC issued some guidance saying you have to tell us what your crypto related activities are. Again, they're concerned about the insurance stamp being on a website with a Bitcoin balance. So they receive a letter notifying them of their intention to engage in digital assets, and they have a bunch of questions. The FDIC plans to do a targeted review of the activities in July 2022, whatever it is, and they send them a list of questions, dozens of questions, reasonable-looking questions, like where does this go on your website, in your app, or where is it going to be with respect to insurance disclosures? Who holds the money, because the money won't be held by the bank, right? The money will be held by some whatever external. Again, think of this from the FDIC's perspective. You can't buy retail products. You can't buy stocks on your bank website, right? If you use a large bank, probably they have a brokerage, equity trading, whatever thing. There's a separate login. There's a separate set of stuff. In the U.S., there's a totally separate insurance thing for that. In parts of Europe, it used to be the case that sometimes your bank would actually be able to do this stuff directly. in Hong Kong, you used to, I don't know actually currently how doable this is, pre-2008 for sure, at cash machines in Hong Kong, you could buy all kinds of derivatives and structured products just with your bank card, basically. That's more restricted now because of 2008 problems with Lehman mini bonds, whatever the rest of it. But generally, particularly in the U.S., this is a U.S. regulatory question. Those things are separate. Those things have really always been separate. Right? You can't go to your Citibank bank app and buy equities, right, or random commodities. You can buy CDs, right? You can, in some cases, you can buy government savings bonds, and there may be an integration to buy certain sort of money market products. That's about it, because all of that stuff is either U.S. government guaranteed or FDIC, which is effectively U.S. government guaranteed. And in that sandbox, that's all you've got. So here we have a bank advised the FDIC of the bank's intent to offer bank customers the ability to buy, hold, and sell Bitcoin through the bank's online banking website and mobile application in conjunction with a Bitcoin trading platform and technology provider. The relationship allows bank customers to purchase and sell Bitcoin through whoever, with funds flowing through the customer's accounts of the bank. Think of what other products you can do that for. You can't. If you want to buy something on Amazon or in a market or whatever, you can send money to the merchant from the bank, but you can't buy the products on the bank website. Right? As you pointed out, we were talking earlier, sometimes you can buy certain types of insurance and other types of financial products. But those relationships are highly regulated.
Yes.
And you would not just slap insurance on the bank website and start selling it to people. There's a procedure to go through. Because that's been done many times for many years, you can probably do that fairly quickly. In this case, you've got people who literally are going to the government saying, we got a live service already, what would you like us to do about it? Right? There's no well-trodden path.
It would be funny, though, if you, whilst you're logging into your online banking account, and then they had a little button at the corner which said, swap everything to BTC.
Well, I mean, fair enough. They should make sure there's no button that says that. Yeah. Because you probably shouldn't allow retail investors to take an interface where up until that day, everything was government guaranteed and just convert all the assets to a thing that's not. Right? That feels like the kind of button that, in the movie, in the fighter plane, you'd have to flip like two switches to get to the button, and then, Denzel and you have to turn keys at the same time. Yeah. Right? You're going to want to make that hard, and that's what they want to do. Now, if you wish to complain that the government's being a bit slow in responding to people,
fair enough.
Actually, we don't have the full timeline, so maybe fair enough.
Yeah, maybe
There's stuff in here references 2021 or not. I don't know. They appear to have been, these are dozens of letters. Is that inundated? I don't know. There's a reasonable number. Now, the fact that they still don't have a full procedure for this 2.5 years later tells you something's not great. That could be the government's very slow. That could be these banks are not operating in good faith. It could be that after the explosions of the last 2 years, these banks withdrew the programs and nobody cares.
Also possible.
Because the FDIC needs somebody to go back and forth with and get a few of these working. And we don't know because, again, the names of the institutions involved are all redacted from all these things. And the titles of people.
Some of these banks might not even exist anymore.
I think we can be pretty confident that some of these banks do not exist anymore, given the number of banks that have, evolved. Clearly, there's going to be banks here where when you read it with the redactions removed, it's much funnier. But we don't know. We haven't tried to remove the redactions.
What I don't see in the letters, though, is, hey, I'm just as big a conspiracy theorist as the next person, but I don't necessarily see anything outside of reasonable questions being asked by your insurer. Just to put this in context, let's say now, for instance, I'm your insurer, and I see your 6-year-old kid driving around in the Lexus that I've insured. Yeah. I'm going to have some questions, which seems reasonable because if that thing gets totaled, I have to pay for that.
Now, this version of the letter is, I think, the most aggressively stop, right? So this is email was sent from a bank saying they were going to provide the bank's intended to provide a crypto asset capability involving some external service provider. At this time, the FDIC has not yet determined what, if any, regulatory filings will be necessary. As a result, we respectfully ask that you not implement this product while we consider this crypto-related activity. May 4th, 2022. So the beginning of the Luna Terra explosion, whatever week. So that's just telling them straight up to stop. Now,
well, they asked, and they asked nicely.
Well,
we respectfully ask.
That's telling them to stop, right? Given that their nature of the relationship.
Not really a directive.
They can pull their charter at any time.
Correct.
If they want to, right.
Yeah.
If you want to look for a situation where the government is stopping people from doing things, right there, the government is explicitly stopping somebody from doing something.
Mm-hmm.
And this particular letter these people don't even seem to be pushing to do it immediately, right? So saying, here is our plan, give us your questions, please review the plan, and then coming back with, we're going to send you some questions and have a meeting, please don't launch the product until we, you can almost see if this was a British regulator, not an American one, it would say, for good order's sake, please note that we would like you to not launch this program until,
Fair enough.
right? This is the American way of saying, for good order's sake, don't do this. This one's, I don't know that I actually see anything wrong with this letter, right? Because they're not asking to launch immediately anyway. You can complain separately the review is too slow. The other letters that say, don't onboard any more customers, stop this because you already launched it and never answered our questions. Yeah, why is your 12-year-old driving your sports car? They're not on the insurance. Like, come on, people, this is weird. So I think if you read them, everybody looks a little bit bad, which is kind of a sign you've got the right theory. I don't know why these banks were also hot to trot here.
I had that question as well. Like,
and the FDIC, look, that they haven't resolved it yet is pretty bad.
Not ideal.
Right. It's been too long. Now, I don't know their side of the story, and if their side of the story is everybody we talked to, we never got past the third meeting because they went bankrupt.
But also,
our different team came in.
To be fair to the FDIC, I'm not necessarily sure it's their responsibility to sort this stuff out.
Yeah, I mean, I can't think of other stuff you can buy on. So some of these may be large banks, but given the offices that are supervising them, you can see which FDIC regional office, the one that's on the screen now, it's Dallas. There aren't a lot of, like Kansas City, Dallas, these are not places supervising a lot of massive banks. And we know who's been involved in the space has generally been small banks nobody had heard of before.
Correct.
So, these are not banks that have, I don't know who this guy's supervising here, but I'm pretty confident it's not somebody that has a full service brokerage with international equity, whatever, as a companion product to the banking app. They don't offer anything else for sale. They offer savings bonds, money market accounts, and bank accounts. Start selling washing machines. Get the approvals clear for that one on your website, and then deal with it.
For the record, it'd probably be possible to interpolate who these banks were because you've got the guy who's in charge of the supervision writing, and they didn't redact his name, and then you know which office it was sent out of, and they didn't redact that, and then you know the timing and the date, and then you just go back to the Internet Archive and figure out who was trying to offer some of this stuff. You could probably get a good sense of who.
A couple of them that launched, assuming they're recent and they're smaller regional offices, you can probably figure out who some of the banks are. We've made no attempt to do so. You can probably do that. I mean, there are some from the New York field office. I'm sure there you can't figure it out. But because there's too many banks. Yeah,
but like the smaller ones, Texas, Kansas, stuff like that, you might probably be able to figure it out. But I mean, nonetheless, if this is what a conspiracy theory is made out of, then I tell you what, chemtrails. That's what we should be talking about.
It really doesn't seem that bad, right? I think this is a manufactured outrage. I mean, were I running one of the questions that are sent back are the same in almost every case, which is good. The government should be sending the same questions. They shouldn't be making the questions up each time, right? But you don't get the sense that these guys came to them with a full proposal that was well thought out about how they could do things, right? Because in many cases they're saying, again, the first one I read, apparently the product's already live. Could you tell us how it works? It doesn't sound like an institution that came in advance with a detailed explanation of how this is going to work.
Seems more like one of those move fast and break things type attitudes.
Yeah. I mean, the one that's up here at the moment, so they had a meeting in February 2022. Then, as a follow-up, the bank sent some details on March 11th. The FDIC sent back questions. This is in April. They requested the responses to that detailed set of questions by June 2022. A couple of weeks, step to step, things moving forward. We don't know what bank it is, so we can't tell you if they got approval in the end because the information is not contained here.
Correct.
But having a meeting in February, then having some exchanges in March, April, and then having the bank send their answers back by June.
Doesn't seem...
If you think that's too slow, I mean, fair enough, but that's how government works. Also, it's not like the bank's able to answer these questions in a day either. Right? In this case, it's 4 or 5 pages worth of.
That's a lot of questions.
I'm going to pick a random thing that I don't know in advance and just read you the classifications. Explain whether the redacted digital markers identify the issuing bank and how, if at all, the distinction is apparent to banks and/or customers. That sounds like a reasonable record-keeping question, right? Provide example general ledger entries for redacted minting, transfer of minting to a customer of another bank, burning of redacted, and settlement due to from balances. Please provide a chart depicting the flow of funds. Okay. I mean, that doesn't sound like a ridiculous question to me, right? Explain any dispute resolution processes contemplated with respect to the third-party service providers, members. Yeah, fair enough, because the money within the bank is insured and the money within the service provider is not, and how are you going to deal with this?
Fair enough.
I mean, like, these don't seem like crazy questions. Again, from the perspective of the person offering the insurance. So, I think people should read these things from the perspective of this guy is providing insurance for all of your liabilities, and he or she. It's women, like 50% of the, you can see the people on the bank side, the government side, he or she. Are they asking reasonable questions? Would you write insurance without knowing this?
Anyway. On that note, thanks for tuning in. Thanks for all your likes, comments, subscribes. We appreciate it when you do that. It helps the algorithm as well. Keep them coming. And we'll see you again next week. Thank you. Have a great weekend. Bye-bye.